House hacking. This can be one of the best ways for a new real estate investor to get started. In this video, I'm going to uncover how some people are buying their first 2 to 4 unit property with as low as 3.5% down. My name is Chris. Welcome to the Empire of Real Estate YouTube channel. On this channel, we talk about real estate, personal finance, and entrepreneurship so you can become the best version of yourself and hit the ultimate goal of financial freedom. If you like this kind of content, smash that like button and subscribe so we can update you as new content comes out. All right, so let's talk about FHA loans for new real estate investors. So FHA can be an awesome way to get started as a new real estate investor. This is actually how I bought my first duplex. I bought this property with very little money down. So let's uncover how you can do the very same thing using this same exact strategy. So the big question, what kind of properties can you actually buy using this loan? You can buy all the way up to 4 units. Anything 4 units or less is considered residential property. So if you're investment minded like myself, you can use this to buy a duplex, a triplex, a fourplex. You can go all the way up to 4 units. Now you do have to live in the property. When you buy it, you have to move in. So you would basically take one of the units and rent out the other ones. So this is really powerful because if you do it right and you work the numbers right, some people are living for free. Some people are, making a little bit of money while doing this, and other people are paying a little bit money out of pocket while they live there. And then when they move out, they're going to have a cash flowing income property. So this is really cool. It's a way for you to get in the door to investment properties with very little money down. Think about it. If you bought a $275,000 property with 3.5%, you're only going to need like $9,625. That's not a ton of money to spend to get into an asset that costs $275,000 and can potentially, make you thousands of dollars per month when it's eventually paid off. So I caught your attention, but how do you actually qualify for this? Like, what is the qualification standards to be able to do this? Well, the first thing the mortgage company is going to look for is your income. So in most cases, if you're a W-2 employee, they're going to look for about 2 years of W-2 income. And they're going to want to see that you make enough money to be able to afford the property that you're looking at. Or if you're self-employed and you own a business, you're going to have to show documentation of that as well. Usually they're going to want to see about 2 years. The third way to do it, and this is something that not everybody realizes, if you just graduated with a degree in the field that you're going to be working in and you get a job and say you don't have that 2 years, they'll actually count your college experience as work experience. Another big factor is credit score. This is something that many people think that they need a super high credit score to be able to get into a house. And that's not always the case. So with FHA loans, depending on which institution you go to, you're going to see 580 credit scores getting approved. As low as 580, I've seen. Some companies have something called overlays where they require a higher score to be able to go through their institution or bank. But in general, if you do some shopping, you should be able to get an FHA loan with as little as a 580 credit score. So the bar isn't super high. This is something that's totally attainable and totally realistic. This is something that you can build up to, and this is something that you can do most likely, depending on your financial situation, in the near future, maybe even sooner than you have thought. The next thing I want to cover is, what should you be looking for when you actually buy something, right? Because buying a property using an FHA loan can be one of the biggest opportunities as a new real estate investor that we have. It's a phenomenal program, and it lets new first-time home buyers get into properties and own properties and experience the benefits of ownership with little money down. And this can be great for somebody that's just starting out, that maybe doesn't have a ton of money saved, and it can be a really huge opportunity. But if you buy the wrong property, it can become a liability and not an asset. So we want to talk about what I personally look for when I'm out there shopping for property. Right off the bat, I usually try to look for the 1% rule. So basically this is 1% of the purchase price in rents per month. And now this isn't a hard rule. There are properties that make good money that don't hit the 1% rule. But if you're scanning through properties, you can simply look at the price, look at the rents, and decide if it's worth digging into deeper. The 1% rule isn't a hard and fast rule that, if it hits that rule, you have to buy it. Or if it doesn't hit that rule, you don't have to buy it, because there are certain factors that come into it. The rents might be under market value. There are many things that weigh into the 1% rule. But as a general rule, just to screen through properties quick, you want to look for a rent roll that's roughly 1% of the purchase price. So for example, if you bought a property that was $300,000, you'd want to see $3,000 a month in gross rents. The next thing is location. Is this location going to appreciate in value, right? And you're also going to be living there. So you have to discover and find out, are you comfortable living in that location? Do you like the location? Is it somewhere that you want to stay for the next couple of years? Another one that's often overlooked is parking. Does the unit have enough parking? If you have a fourplex and each unit has 2 bedrooms, well, you're going to have enough parking for all those tenants to be able to put their cars somewhere. And if you live in a cold environment where there's snow and you don't have enough parking, you're going to have a really big management headache when you have to go find places for these people to park off street when the plows come around. So these are things to deal with. I personally don't buy properties that don't have driveways and parking lots. I don't want to deal with it, because what's going to happen is this. Right now, you'll probably be able to rent it. The rental market's hot. But if the rental market ever gets cold and, there's a lot more inventory on the market and tenants have more selection and they get to pick and choose what they want because there's just so much inventory, if that ever happens, what's going to happen is those properties without driveways and parking, they're going to be the first ones that go vacant. And they're going to be the landlords that are, running around trying to figure out how to get their unit vacant. And they're going to have to probably be doing the price cuts on the rents. So take your time. Really look into this and find the right property that's the right fit. Just don't go out there and buy everything. You have to factor in multiple things, and you have to factor in parking. The next thing is actually crunching the numbers, right? So you don't want to just look at the mortgage. You want to also look at how much is the property insurance going to be? How much is the property tax going to be? How much am I going to allow for vacancies? Like, am I going to do 10% of the monthly rent for vacancy? At that point, if you were making $3,000 a month in rent, you'd allow $300 a month just for vacancy when it happens. This stuff is all called CapEx, right? Now, one thing to consider is you want to find out what it's going to cost you to live in the property while you live there, and then what is it going to make you when you make an exit. So a quick example, if you buy a property that's $275,000 and the mortgage is, say, $2,200 with the insurance, the real estate taxes, and everything, combined with the PMI and all that kind of stuff, and you get $1,000 on the first floor, $1,000 on the second floor, and $1,000 on the third floor, you're going to have a property that takes in $3,000 a month. So you're going to live in one of the units. So you're going to take away one of the 1,000s. So you have $2,000 a month coming in, and you have a bill for $2,200. So that property is going to cost you about $200 a month to live there. And that's, saying that you're not going to have any vacancy, which you probably will. And that's saying that nothing's going to break. At the end of the day, though, that's probably a pretty good deal. And then once you leave the property, you might have equity. Maybe you can refinance and lower that mortgage payment. That's something I just did on my FHA loan, is I refinanced because my property shot up in value based on what I bought it for. And the second thing is, once you make an exit from that property, you're going to make about $800. So if you rent your unit out for $1,000 and your mortgage is $2,200, you have $3,000 coming in, you have $800 that is going into your pocket. Now, keep in mind, you want to factor in vacancy, you want to factor in repairs, all that kind of stuff. So it might not be a pure, $800 a month, but in general, that's a pretty good deal. Because keep in mind, if you bought this property for $275,000 using an FHA loan, you really only invested $9,625. And once you leave that property and move into another property, what's going to happen is if you have $800 a month coming in, for 12 months, that's $9,600. So you almost got out of the property what you even put in to buy it. And that's going to spit out that money every single year. And now what happens if rents go up, right? What happens if the property value goes up and you can refinance and get rid of the PMI? Like, all these things factor in. And in general, rents typically do rise and property values typically do rise. So you can put yourself into an excellent situation where you acquire a cash flowing asset for very little money. So take advantage of this. Use this tool. It's out there for first time homeowners, and it's a great way to house hack and get into a property that you can live in and enjoy while also receiving rental income. And then once you get done with that property, and once you don't want to live there anymore, it can turn into a cash flowing income producing asset. So this is a powerful thing, guys. I hope you like this video. If you have questions about it, drop them in the comment section below. And I would also love to hear your success stories on maybe how you went out there and house hacked a duplex, a triplex, or a 4-unit. So drop that in the comment section below, and I look forward to hearing it. Have an awesome day.